Welcome to Tax Trap Alert, Traditional versus Roth 401k. In this video, we will show you why your 401k choice could cost or save you thousands. We will focus on when you pay taxes, either now with Roth or later with traditional. Stay with us as we break down the trade-offs, provide decision frameworks, and share practical action steps along with a couple of quick quizzes. Let's begin. Here's our roadmap. First, we present the big idea of paying taxes now or later. Next, we cover traditional and then Roth 401k use cases. After that, we compare them side by side and discuss a powerful but sometimes controversial combination strategy. Then we move into clear action steps and mini case studies with quick math. We will also include diagrams to visualize the concepts and 2 short quizzes to test your understanding. Finally, we will wrap up with a concise summary and next steps. At the core of this decision is timing. With a Roth 401k, you pay taxes now on contributions, but future qualified withdrawals are tax-free. With a traditional 401k, you defer taxes today and reduce your current taxable income, but you will pay ordinary income tax on withdrawals in retirement. In short, you are choosing when to pay the government, now or later. With that foundation, let's move to traditional 401k specifics. Traditional 401k contributions are made pre-tax. This immediately reduces your taxable income, which is especially valuable if you are currently in a high marginal tax bracket. Your investments then grow tax-deferred. However, all distributions in retirement are taxed as ordinary income. This route tends to work best if you expect your retirement tax bracket to be lower than your current bracket. Traditional 401k accounts are also subject to required minimum distributions under current rules, which means you must start withdrawing and paying taxes at a certain age unless laws change. Now, having said that, let's transition to when the Roth 401k shines. Roth 401k contributions are made with after-tax dollars. You pay the tax now, but qualified withdrawals in retirement are tax-free, including the growth. This can be ideal if you are currently in a low tax bracket, anticipate significantly higher earnings later, or expect higher tax rates in the future. Beginning in 2024, Roth 401k accounts are not subject to required minimum distributions, and Roth IRAs have always avoided RMDs. Next, let's compare traditional and Roth side by side to clarify the differences. On the left, the traditional 401k uses pre-tax contributions to lower your current taxable income, with taxes owed later on distributions. This is often best when you expect to be in a lower tax bracket in retirement. However, required minimum distributions generally apply. On the right, the Roth 401k uses after-tax contributions and provides no immediate deduction, but qualified withdrawals are tax-free. This is advantageous when your future brackets or rates are expected to be higher, and as of 2024, there are no required minimum distributions for Roth 401k accounts. With the key differences laid out, let's move into a nuanced strategy that blends both benefits. A powerful and sometimes controversial approach for high-income earners is to maximize contributions to a traditional 401k for the immediate deduction and combine that with contributions to a separate Roth IRA. This mix creates tax diversification, providing both present-day tax relief and future tax-free income sources. If your income is too high to contribute directly to a Roth IRA, you may investigate the backdoor Roth IRA strategy, where you make a non-deductible traditional IRA contribution and then convert it to Roth, subject to pro rata rules and potential tax complications. Now that we have covered the strategy, let's turn it into practical steps you can follow. Here are clear steps. First, identify your current marginal tax bracket. Second, estimate your expected retirement tax bracket based on pensions, Social Security, required distributions, and other income. If you feel heavily taxed today, favor traditional 401k contributions. If you are lightly taxed today or anticipate higher tax rates or income in retirement, favor Roth 401k contributions. Build tax diversification by contributing to a Roth IRA when eligible, or via a backdoor process if appropriate and permissible. Reevaluate annually because your income, goals, and laws change. Also, coordinate with other accounts like health savings accounts and taxable brokerage accounts to maintain flexibility. Next, let's ground this with a quick reference table of key features and limits. This table summarizes key differences and 2024 limits, which can change, so verify current IRS guidance. Traditional 401k and Roth 401k share the same deferral limits, with catch-up amounts for those age 50 and older. Roth IRA contributions have lower limits and income phase-outs. Tax timing and RMD rules differ as shown. Early withdrawal rules and 5-year requirements can also affect outcomes. With the quick reference in mind, let's visualize a decision journey next. This decision flow starts by asking about your current marginal tax bracket. If it is high, you lean toward traditional 401k. If it is not high, you lean toward Roth 401k. Then, consider your expected retirement bracket. If it will be lower, the traditional approach becomes even stronger. If it will be higher, the Roth approach becomes stronger. If you are uncertain or in the middle, blend contributions to create tax diversification. Now, to deepen the concept of diversification, let's generate a broader strategy map. This mind map places tax diversification at the center. One branch highlights pre-tax accounts, such as traditional 401k and traditional IRA, that offer immediate deductions, allow bracket management through deferral, and typically come with required minimum distributions. Another branch shows after-tax Roth accounts like Roth 401k and Roth IRA, emphasizing tax-free qualified withdrawals, no RMDs, and a hedge against rising tax rates. A third branch shows taxable brokerage accounts, noting preferential capital gains rates, the ability to harvest losses, and general flexibility. A fourth branch shows health savings accounts for those eligible, with triple tax advantages and utility for medical spending or bridging gaps in retirement. Finally, the map includes risks such as legislative changes, sequence of returns risk, and behavioral risk. With the big picture established, let's explore quick case studies using simple math. In case A, consider a high earner in the 24% marginal bracket contributing $23,000. A traditional 401k contribution would save approximately $5,520 in the current tax year. In case B, consider someone in the 12% bracket now who expects to be in the 24% bracket later. Paying 12% now via Roth to avoid paying 24% later can be favorable. In case C, if uncertainty remains, split contributions to diversify tax exposure. As a simple framework, compute the now tax cost as contribution times your current marginal rate, and the later tax cost as contribution times the expected retirement marginal rate. With numbers in mind, let's reinforce learning with a quick quiz. Quiz time. The question is, if you are in a 35% marginal bracket today and expect to be in a 22% bracket in retirement, which account typically offers the better tax outcome? The options are traditional 401k, Roth 401k, taxable brokerage account, or skip saving and hold cash. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is traditional 401k. You defer taxes today at 35% and pay later at 22%, thereby exploiting the difference between your current and future tax brackets. This bracket spread is the core reason traditional tends to win in that scenario. Next, let's try one more question about combining strategies. Second quiz. A high-income earner wants immediate tax relief but also wants future tax-free income streams. Which combination often delivers both? The options are max traditional 401k plus contribute to Roth IRA, or backdoor Roth if needed. Max Roth 401k only. Only invest in taxable brokerage, or skip retirement accounts entirely. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to maximize the traditional 401k while also contributing to a Roth IRA, or using a backdoor Roth if necessary and appropriate. This approach provides current year tax relief through the traditional contribution and tax-free qualified withdrawals through the Roth IRA, yielding broad tax diversification. Now, before we summarize, let's add an important disclaimer. This content is for educational purposes only and is not tax, legal, or investment advice. Your situation is unique and laws change. Consult a qualified professional and verify current IRS limits and rules before making decisions. With that clear, let's wrap up with key takeaways. The main points are as follows. Traditional 401k means paying later and generally works best when your current tax bracket is higher than your expected retirement bracket. Roth 401k means paying now and works best when you expect higher brackets or rates later. If you are unsure, diversify between the two. High-income earners may combine traditional 401k with a Roth IRA to gain present tax relief and future tax-free income. Finally, revisit these choices annually because your circumstances and regulations evolve. Next, a concise summary and your next steps. To summarize, anchor your decision on your current tax bracket versus your expected bracket in retirement. Traditional 401k lowers taxes today, while Roth purchases future tax freedom. When in doubt, blend contributions for diversification. Confirm current contribution limits and consider whether backdoor Roth rules apply to you. Establish a yearly review process with a professional or a detailed checklist. Finally, here is a creative send-off. Thanks for watching. If this video helped clarify your 401k choice, please like the video, share it with a friend who is deciding between traditional and Roth, and subscribe for more clear, practical guides. Comment with your current tax bracket guess and whether you plan to lean traditional, Roth, or blend them this year. See you in the next one.